Today, the Hedge Fund Journal is sitting in the offices of EY in London, overlooking London's Tower Bridge. We are privileged to have with us Mike Serota, who is a recipient of one of the Hedge Fund Journal's special awards for an outstanding contribution to the hedge fund industry. Well, Mike, thanks very much for joining us today. We understand that you flew in overnight from New York, so we hope you're not too jet-lagged.
I'll do my best.
Right. So when did you join EY, and how has your career progressed?
It's actually 10 years. I've been with EY for 10 years. I was originally with Arthur Andersen, and then after Andersen collapsed, I ultimately moved over to EY. So it's been about 10 years at this point, and the career is, it's really been a great career. I feel like I landed at the firm that really understood the industry and really put everything behind it and devoted a significant amount of resources and capital to growing the industry and growing the client base and supporting it.
So since you joined EY a decade ago, hedge fund industry assets have roughly tripled from about $1 trillion to about $3 trillion. Over that period, how has EY's offering changed?
I think it's really a question of how the industry has changed, right? So the industry has really globalized and institutionalized more so over the last 10 years. I think when the industry first started, and probably up until 10 or 15 years ago, I think a lot of it was a compliance-driven industry from an assurance and a tax perspective. But over the last 10 years, maybe 15 years, as the industry has globalized and institutionalized, you've seen a real change or expansion in scope of needs by our clients and scope of services that we provide. Cross-border issues, regulatory issues, transactional issues. You look at the typical hedge fund today, maybe not the typical hedge fund today, but to say the future of the industry, and it's really more about asset managers and asset gatherers. And those types of asset managers and asset gatherers really have an institutionalized and globalized focus. So I think as we look forward and you project out a number of years, you're going to see hedge funds that are more in the line of asset managers and have multiple types of offerings underneath their overall structure.
So how big is your hedge fund team, and is it still growing?
Yeah, it's still growing. I would say we've grown by a factor of 8 times or so in the last 10 years across all of our different offerings. Primary offerings, assurance, advisory, and tax. I would venture to say we have more than 2,000 people that work in the industry exclusively. They don't do anything other than work on hedge funds, and in excess of 200 partners and directors that work in the industry. And our focus is really still the same. It's really focused on startups and supporting the industry and working with them as they develop. And also supporting the industry more broadly. We spend a lot of time working with charitable organizations to support the industry, such as Robinhood and Hedge Funds Care.
Right. How do you actually measure your market leadership, and what do you think your strongest and any weakest areas might be?
We think we have about a 40% market share through all the major tranches, say larger funds over $500 million in assets under management, and we look at the statistical information, and that's what our view is. It's about 40%, give or take, depending upon how asset flows are in any particular period. And that's been fairly steady for a number of years.
What are the advantages of using a global firm as opposed to using a selection of local firms in different countries or jurisdictions?
I think part of that goes back to some of the earlier questions you asked. If you have an asset manager that is globalizing and institutionalizing, they need to have connectivity at one central point. They can't use multiple service providers and really be that effective and efficient. You have to have points of contact that can function as a quarterback, more or less, for an entire global structure. And when you have a fund that is, take an example, let's say a fund starts in London, then migrates some of its operations to New York and some of its operations to Hong Kong or Singapore, which is typically what happens, or they may start in New York or vice versa. You have to have the ability to provide services cross-border and provide a seamless point of contact for that overall global advice. So it really becomes a critical issue when a fund globalizes and institutionalizes.
Which of your offices is growing fastest globally?
It's hard to say. I think I would look at it in terms of geographic regions and where the opportunity is. All the offices are growing. Whether it's, you look at the US as one unit, which is generally what we do, or you look at London, or you look at continental Europe, or you look at Asia, all the offices are growing, and they've all been growing at a significant pace which has been consistent over the last, at least since I've been with the firm 10 years, longer. But I think if you look at regions in terms of where opportunity is, clearly there is major opportunity in three places, I think, if you look forward. China, I think, is going to be explosive. Mainland China is going to be explosive. India is going to be explosive. It's already starting to be, and I think South America, really as an entry point through Brazil, is going to be very interesting and is going to have explosive growth in this industry. In fact, I read that Brazil has a sixth largest hedge fund industry globally, which most people probably don't realize or know, but that's a fact. So, I don't know how it was measured necessarily, but even if it's not entirely accurate, it's directionally correct. So it just gives you a sense as to these emerging economies, emerging markets, where the opportunities are, which I think is really what the focus needs to be.
Which areas of regulation are you most focused on now?
Well, clearly AAFMD and FATCA are very important for all of our clients, but I think it's really helping our clients through the regulatory structure, especially as they launch regulated products. So whether it's a UCITS product or it's a liquid alts product, a BDC, it really doesn't matter. There are regulatory issues that we need to work with them on. The SEC is obviously very focused on the industry right now. It's focused on the regulatory environment. And cybersecurity is becoming a very big issue, I think, as everybody knows. It may be the biggest issue out there right now, and everybody is, if they're not concerned about it, they should be concerned about it. They should be focused on it.
The other day we spoke to AIMA, the Alternative Investment Management Association, and they told us that judging by the number of consultation papers they're asked to comment on, they think the pace of regulatory change is slowing down. Does that match up with your experience?
I don't know. I'm sure AIMA is right. I think that it's really a question of how products develop, how the industry develops, how cash flows continue to come in. The industry is still continuing to grow, both from an AUM perspective and from a product diversification perspective. The pace of change is only quickening. So I don't know that I would say definitively that regulatory change is going to slow down. But I obviously respect their view, and they're probably right. But I think we just need to wait and see what happens. But the industry is just continuing to grow, new products, new opportunities, and that will bring new regulatory oversight.
Yeah. Do you think there is a genuine danger of hedge funds getting caught in the FATCA net? And what steps can they take to safeguard against that?
At this point, I would hope not. I would hope there wouldn't be a danger. I mean, this has been out there for so many years at this point, and it's been delayed so many times that the major hedge funds should all be compliant, understand what they're doing. The fund administrators understand the business and the needs. They're critical to the process. They've been engaged. They know what they're doing. So I would think that the major hedge funds, the larger hedge funds, the ones with significant assets, and you can even say, those that are of decent size, maybe north of $200-300 million, $400 million, all have done what they're supposed to do. If they use a fund administrator, the fund administrator's been telling them what to do, and they've been coached through the processes that they need to go through. So I don't think at this point that I'm all that concerned about a hedge fund falling afoul of it. So hopefully I'm right.
Right. Moving over to Europe, do you have any views on the LuxLeaks controversy?
I really can't comment on the LuxLeaks. What I can comment on is the fact that all hedge funds really need to review their cross-border setups, just as a matter of course. They need to understand how they're structured, have they done the right things to make sure their structure passes scrutiny and do so in a robust way. And I think that what this just suggests is that there really needs to be a re-examination of how the structures work. Do they make sense? Are they viable? Have they gotten good advice? And is their platform sustainable in the event that they are reviewed?
Once again, the EY survey was released for 2014. And it's become a very respected reference point for the industry. I think we all know that regulatory compliance costs are continuing to rise. So moving on to perhaps some more positive aspects of the survey, how are hedge funds growing their assets and diversifying their investor bases through new types of products, structures, and vehicles.
So the hot item last year was liquid alternatives, and hedge funds were doing it for a couple of reasons. One was to diversify their client base and to offer new products to their clients. And as I mentioned earlier, the industry is changing. The hedge funds are offering new products to their client base. They're diversifying. They're becoming asset managers. So liquid alternatives are a way to do that. BDCs, UCITS, managed accounts, long-only funds, all along the same path of developing new product and giving clients additional ways to invest with them. So I think that pace will obviously continue. I think you'll see more funds launching products along those lines. Doesn't matter where they are, whether they're in the U.S. or Europe or Asia. Obviously, I think a lot of that started with, there was more of that in the U.S. and the U.K. at first, and continental Europe. I think Asia will pick up the pace as well.
Right. And on the less liquid side, do you see signs of hedge funds converging towards private equity models in areas such as direct lending?
It's a good question. I think what's happening is that you have a hedge fund that has investors, and those investors want different types of products and opportunities. One of those is a private equity-like or type stream, and it might be direct lending, it could be a credit operation, or it could just be a pure play private equity fund, along the lines of offering new products. And I think you see the same thing on the private equity side, where the major private equity shops may be launching hedge fund-like products or other types of products to their client base. So that goes back to the earlier point that you have all of these larger organizations, whether they're hedge funds or private equity funds, moving down the path of becoming asset managers, offering different types of products to their clients, and really moving along that path. So I think that that's all consistent. I think that started maybe 3 years ago, 4 years ago, but it's definitely picked up the pace in the last few years, the last couple of years rather.
Well, Mike Serota of EY, thanks very much for your time and insights today. And we look forward to watching the continued growth of EY and the hedge fund industry.
It was my pleasure. Thank you.